bleak is the outlook for oil prices, Jason? You recently upgraded your forecast.
It's pretty dire, and the volatility in prices is obviously quite high as well. But we are looking at the markets. We are looking at demand destruction being in the range of 15 to 20 million barrels a day in April, and potentially in the 12 million barrel a day range in the second quarter. So even a 10 million barrel a day cut from OPEC, if it's achieved today, still leaves you in a very oversupplied market, and that makes it very tough for prices to find the floor. So, we have a $35 forecast for the second quarter, but I'd say that the risk is to the downside.
So if you look at the oil majors then, Jason, what does that mean in terms of the outlook for buybacks and dividends? You've, I believe, eliminated all buyback and dividend increases in your models through 2025. Is that a little bit aggressive if you do expect some kind of recovery in oil prices before 2025?
It is aggressive, but I think that the key considerations here are more related to the depth and duration of the price downturn. And if oil prices stay below $40 a barrel for, let's say, an 18-month time frame, then balance sheet repair is actually going to be a very high priority for a lot of these companies. So I think the existing dividends are safe, but the path to dividend increases it's a little difficult to see at the current time.
Interesting that you say that current dividends are safe. So you're not expecting dividend cuts. Is that just for the super majors or across the industry?
Well, I'd say it's primarily for the super majors. I do cover Occidental Petroleum, who obviously took a very big cut to their dividend a few weeks ago. But I think that the actions that we've seen from the big integrated companies, eliminating buyback programs and cutting CapEx by 20% plus, leaves them in a position of very strong liquidity. And given that the dividend is their highest financial priority, that's why I think it's safe.
Who, Jason, of the companies that you cover has the most capacity for capital preservation at this time, which you highlight is going to become a priority for a lot of these oil majors? Who has the most capacity to preserve that capital without hurting future growth?
I think that Chevron is probably the best position within the industry. It starts the downturn with by far the strongest balance sheet in the sector, and I think that having the dry powder on the balance sheet is pretty important right now. I would say that Total is also in pretty good shape in that regard, having a strong balance sheet, plenty of liquidity, and both companies have cut their capex by 20%.